Hello, everyone, and welcome back to Leah's Lifestyle. We're on another investing adventure where, because of Invested and Rule 1 podcast with Phil Town and Danielle Town, we are now going to start reading the Berkshire Hathaway letters to. This one says letters to chairman, but they're supposed to be letters to. I just realized it says letters to chairman. Is that different? Is that different? Hold on one second. I'll edit it, don't worry. Investing. Shareholder letters. Berkshire shareholder letters. Okay, yeah. So they just changed the name of it. Okay, cool. Anyways, we're going to start reading these from 1977 and work our way up to the current year. This paper that we have goes to 2024, so I'm sure we can find 2025 and 2026, but we'll worry about that when we get there, and trust me, there's some time before we do that. So I'm just going to get right into it. We're going to read straight through it. I'm going to try and not make too many comments as we go through and wait to make comments till the very end, so that way you don't have to be interrupted while you're listening. Without further ado, let's get into our 1977 Berkshire Hathaway letters to shareholders. To the shareholder of Berkshire Hathaway Inc., operating earnings in 1977 of $21,904,000 or $22.54 per share were moderately better than anticipated a year ago. Of these earnings, $1.43 per share resulted from substantial realized capital gains by blue chip stamps, which, to the extent of our proportional interest in the company, are included in our operating earning figure. Capital gains or losses realized operating earnings figures. Capital gains or losses realized directly by Berkshire Hathaway Inc. or its insurance subsidiaries are not included in our calculations of operating earnings. While too much attention should not be paid to the figure for any single year, over the long term, the record regarding aggregated capital gains or losses obviously is significant. Textile operations came in well below forecast. While the results of the Illinois National Bank, as well as the operating earnings attributed to our equity interest in blue chip stamps, were about as anticipated, however, insurance operations, led again by the truly outstanding results of Phil Lissky's managerial group at National Indemnity Company, were even better than our optimistic expectations. Most companies define record earnings as a new high in earnings per share, since business customarily add from year to year to their equity base. We find nothing particularly noteworthy in a management performance combining, say, a 10% increase in equity capital and a 5% increase in earnings per share. After all, even a total dormant savings account will produce steadily rising interest earnings each year because of compounding. Except for special cases, for example, companies with usually debt equity ratios or those with important assets carried at unrealistic balance sheet values, we believe a more appropriate measure of managerial economic performance to be return on equity capital. In 1977, our operation earnings on beginning equity capital amounted to 19%, slightly better than last year and above both our own long-term average and that of American industry in aggregate. But while our operation earnings per share were up 37% from the year before, our beginning capital was up 24%, making the gain in earnings per share considerably less impressive than it might appear at first glance. We expect difficulty in matching our 1977 rate of return during the forthcoming year. Beginning equity capital is up 23% from a year ago, and we expect the trend of insurance underwriting profit margins to turn down well before the end of the year. Nevertheless, we expect a reasonably good year at our present estimate, subject to the usual caveats regarding the realities of forecast is that operating earnings will improve somewhat on a per share basis during 1978. Textile operations. The textile business, again, had a very poor year in 1977. We have mistakenly predicted better results in each of the last 2 years. This may say something about our forecasting abilities, the nature of the textile industries, or both. Despite strenuous efforts, problems in marketing and manufacturing have persisted. Many difficulties experienced in the market area are due primarily to industry conditions, but some of the problems have been of our own making. A few shareholders have questioned the wisdom of remaining in the textile business, which, over the long term, is unlikely to produce returns on capital comparable to those available in many other businesses. Our reasons are several. 1. Our mills in both New Bedford and Manchester are among the largest employers in each town, utilizing a labor force of high average age, processing relatively non-transferable skills. Our workers and unions have exhibited usually understanding and effort in cooperating with the management to achieve a cost structure and product mix which might allow us to maintain a viable operation. 2. Management also has been energetic and straightforward in its approach to our textile problems. In particular, Ken Chase's efforts after the change in corporation control took place in 1965 generated capital from the textile division needed to finance the acquisitions and expansion of our profitable insurance operations. 3. With hard work and some imagination regarding manufacturing and marketing configurations, it seems reasonable that at least modest profits in the textile division can be achieved in the future. Insurance underwriting. Our insurance operations continue to grow significantly in 1977. It was early in 1967 that we made our entry into this industry through the purchase of National Indemnity Company and National Fire and Marine Insurance Company, sister companies, for approximately $8.6 million. In the year, their premium volume amounted to $22 million. In 1977, our aggregate insurance premium allows us $151 million. No additional shares of Berkshire Hathaway stock have been issued to achieve any of this growth. Rather, this almost 600% increase has been achieved through large gains in National Indemnity's traditional liability areas, plus the starting of new companies. Cornhusker Casual Company in 1970, Lakeland Fire and Casual Company in 1971, Texas United Insurance Company in 1972, the Insurance Company of Iowa in 1973, and Kansas Fire and Casualty Company in late 1977. The purchases for cash of other insurance companies, home and automobile insurance companies in 1971, Kirkland Reinsurance Corporation, now named Central Fire and Casualty Company in 1976, and Cypress Insurance Company at year-end 1977. And finally, through the marketing of additional products, most significantly reinsurance, within the National Indemnity Company Corporation structure. In aggregate, the insurance business has worked out very well, but it hasn't been a one-way street. Some major mistakes have been made during the decade, both in products and personal. We experienced significant problems from 1. A surety operation initiated in 1969. 2. The 1973 expansion of home and automobiles urban auto marketing into the Miami, Florida area. 3. A still unresolved aviation fronting arrangement, and 4, our workers' compensation operation in California, which we believe retains an interesting potential upon completion of a reorganization now in progress. It is comforting to be in a business where some mistakes can be made and yet a quite satisfactory overall performance can be achieved. In a sense, this is the opposite case for our textile business, where even very good management probably can averagely only modest results. One of the lessons your management has learned, and unfortunately sometimes relearn, is the importance of being in business where tailwinds prevail rather than headwinds. In 1977, the winds in insurance underwriting were squarely behind us. Very large rate increases were effective throughout the industry in 1976 to offset the distress underwriting results of 1974 and 1975. But because insurance policies typically are written for 1-year periods with pricing mistakes capable of correction only upon renewal, it was 1977 before the full impact was felt upon earnings and those earlier rates increased. The pendulum now is beginning to swing the other way. We estimate the costs involved in the insurance area in which we operate rise at close to 1% per month. This is due to continuous monetary inflation affecting the cost of repairing humans and property, as well as social inflation, a bordering definition by society and juries of what it is covered by insurance policies. Unless rates rise at a comparable 1% per month, underwriting profits must shrink. Recently, the price of rate increase has slowed dramatically, and it is our expectation that underwriting margins generally will be declining by the second half of the year. We must give credit to Phil Lishine, greatly assisted by Ronald Miller in underwriting and Bill Loynes in claims, for an extraordinary underwriting achievement in national indemnity and traditional auto and general liability businesses during 1977. Large volume gains have been accompanied by excellent underwriting margins following contraction or withdrawal by many competitors in the wake of the 1974-75 crisis period. These conditions will reverse before long. In the meantime, National Indemnity's underwriting profitability has increased dramatically, and, in addition, large sums have been made available for investments. As markets loosen and rates become inadequate, we, again, will face the challenge of philosophically accepting reduced volume. Usually, marginal discipline will be required, as it runs counter to normal institutional behavior to let the other fellow take away business, even at foolish prices. Our reinsurance department, managed by George Young, improved its underwriting performance during 1977, although the combined ratio, see definition on page 12, of 107.1 was unsatisfactory. Its trend was downward throughout the year. In addition, reinsurance generates usually high funds for investment as a percentage of premium volume. At home and auto, John Seward continued to make progress on all fronts. John was a battlefield promotion several years ago. Company faced possibly extinction. Under his management, it currently is sound, profitable, and growing. John Ringwald's home state operation now consists of 5 companies, with Kansas Fire Casualty Company becoming operational late in 1977 under the direction of Floyd Taylor. The home state companies and net premium volumes of $23 million, up from $5.5 million just 3 years ago. All 4 companies that operate through the year achieved combined ratios below 100, with Cornhuskers Casualty Company at 93.8, the leader. In addition to actually supervising the other For homestead operations, John Ringwalt manages the operations of Cornhusker, which has record combined ratios below 100 in 6 of its 7 full years of existence, and from a standing start in 1970 has grown to be one of the leading insurance companies operating in Nebraska, utilizing for conventional independent agency systems. Nebraska utilizes the conventional independent agency system. Lakeland Fire and Casualty Company, managed by Jim Sudelock, was the winner of the Chairman's Cup in 1977 for achieving the lowest loss ratio among the homestead companies. All in all, the homestead operation continues to make excellent progress. The newest addition in our insurance group is Cypress Insurance Company of South Pasadena, California. This workers' compensation insurer was purchased for cash in the final day of 1977, and therefore its approximate $12.5 million of volume for that year was not included in our results. Cypress and National Indemnity presents California workers' compensation operation will not be combined, but will operate independently, utilizing somewhat different marketing strategies. Milt Thornton, president of Cypress since 1968, runs a first-class operation for policyholders, agents, employees, and owners alike. We look forward to working with him. Insurance companies offer standardized policies which can be copied by anyone. Their only products are promises. It is not difficult to be licensed, and rates are on open books. There are no important advantages from trademarkers, patents, locations, corporation longevity, raw material sources, etc., and very little consumer differentiation to produce insulation from competition. It is commonplace in corporate annual reports to stress that difference that people make. Sometimes this is true, and sometimes it isn't. But there's no question that the nature of insurance business magnifies the effect which individual managers have on company performance. We are very fortunate to have the group of managers that are associated with us. Insurance investments. During the past 2 years, insurance investments at cost, excluding the investment in our affiliate blue chip stamps, have grown from $134.6 million to $252.8 million. Growth in insurance reserves produced by our large gain in premium volume, plus retained earnings, have accounted for this increase in marketable securities. In turn, net investment income of the insurance group has improved from $8.4 million pre-tax to 1975 to $12.3 million pre-tax in 1977. In addition to this income from dividends and interest, we realized capital gains of $6.9 million before taxes, about 1/4 from bonds and balances from stocks. Our unrealized gain in stock at year-end 1977 was approximately $74 million, but this figure, like any other figure of a single date, we had an unrealized loss of $17 million at the end of 1974. Should not be taken too seriously. Most of our large stock positions are going to be held for many years, and scorecard on our investment decisions will be provided by business results over that period, and not by price on the given day. Just as it would be foolish to focus unduly on the short-term prospects when acquiring an entire company, we think it equally unsound to become mesmerized by prospective near-term earnings or recent trends in earnings when purchasing small pieces of companies, i.e., marketable common stock. A little discretion a little discretion illustrating this point may be interesting. Berkshire Fine Spinning Associates and Hathaway Manufacturing are merged in 1955 to form Berkshire Hathaway Inc. in 1948 and a pro forma combined basis. They had earnings after tax of almost $18 million and employed 10,000 people at a dozen large mills throughout New England. In the business world of that period, they were an economic powerhouse. For example, in the same year, earnings of IBM were 28 million, now 2.7 billion. Safeway Stores 10 million, Minnesota Mining 13 million, and Time Inc. 9 million. But in the decades following the 1955 merger, aggregate sales of 595 million produced by aggregate loss for Berkshire Hathaway of 10 million. By 1964, the operation had been reduced to 2 mills and net worth had shrunk to 22 million from 53 million at the time of the merge. So much for single year snapshots as adequate portrayals of the business. Equity holdings of our insurance companies with a market value of over 5 million on December 31st, 1977 were as follows. And then there's this little number of shares, the company name, cost, and market. So they had 220,000 shares of Capital Cities Communication Inc. cost them a little over 10,000, and the market is at a little over 13,000. 1,986,953 shares of Government Employee Insurance Company Convertible Preferred got at a little over 19,000, and now is at 33,000. 1,294,308 government shares of Government Employees Insurance Company Common Stock at 4,000, now at 10,000. 592,650 shares of the Interpublic Group of Companies Inc. got at 4,500, now at 17,000. 324,580 stock shares of Kaiser Alumni and Chemical Corporation, they got at 11,000, but now is at 9,900. 1,305,800 of Kaiser Industry Inc. got at $778, is now at 6,000. 226,900 shares of Knight Ridder Newspaper Inc. got at 7,500, is now at 8,700. 170,800 of Ogilvia and Mather International Inc. got at 2,700, is now at 6,960. 934,300 of stocks of the Washington Post Company Class B at 10,600 is now at 33,400. The total that they cost was 71,893, with other holdings being at 34,996, a total of 106,889. Then the market value continuing at 181,073. We select our marketable equity securities in much the same way we would evaluate a business for acquisition in the entirety. We want the business to be one that we can understand, 2, with favorable long-term prospects, 3, operated by honest and competent people, and 4, available at a very attractive price. We originally make no attempt to buy equities for anticipated favorable stock prices behavior in the short term. In fact, if their business experience continues to satisfy us, we welcome lower market prices of stock we own as an opportunity to acquire even more of good things at a better price. Our experience has been that pro rata portions of truly outstanding businesses sometimes sell in the security markets at a very large discount from the price they would command in negotiated transactions involving entire companies. Consequently, bargains in business ownership, which simply are not available directly through corporate acquisitions, can be obtained indirectly through stock ownership. When prices are appropriate, we are willing to take very large positions in selected companies, not with any intention of taking control and not foreseeing sellout or merger, but with the expectation that excellent business results by corporations will translate over the long term into correspondingly excellent market value and dividend results for owners, minority as well as majority. Such investments initially may have negligible impact on our operation earnings. For example, we invested $10.9 million in Capital Cities Communication during 1977. Earnings attributed to the shares we purchased total about $1.3 million last year, but only the cash dividend, which currently provides $40,000 annually, is reflected in our operation earning figure. Capital cities possess both extraordinary properties and extraordinary management. And these management skills extend equally to operations and employment of corporate capital. To purchase directly properties such as Capital Cities owns would cost in the area of twice our cost of purchase via the stock market, and direct ownership would offer no important advantages to us, while control would give us the opportunity and the responsibility to manage operations and corporate resources. We would not be able to provide management in either of those respects equal to that now in place. In effect, we can obtain a better management result through non-control than control. This is an unorthodox view, but one we believe to be sound. Banking. In 1977, the Illinois National Bank continued to achieve a rate of earnings on assets about 3 times that of the most large banks. As usual, this record was achieved while the bank paid maximum rates to savers and maintained the asset position combined low risk and exceptional liquidity. Gene Abbage formed the bank in 1931 with $250,000. In its first full year of operation, earnings amounted to $8,782. Since that time, no new capital has been contributed to the bank. On the contrary, since our purchase in 1969, dividends of $20 million have been paid. Earnings in 1977 amounted to $3.6 million, more than achieved by many banks 2 or 3 times its size. Late last year, Gene, now 80 and still running a banking operation without peer, asked that a successor be brought in. Accordingly, Peter Jeffrey, a formerly president and chief executive officer of American National Bank of Omaha, has joined the Illinois National Bank effective March 1st as president and chief executive officer. Gene continues in good health as chairman. We expect a continued successful operation at Rockford's leading bank. Blue chip stamps. We again increased our equity interest in blue chip stamps and owned approximately 36.5% at the end of 1977. Blue chip had a fine year, earning approximately $12.9 million from operations and, in addition, had realized security gains of $4.1 million. Both Wesco Financial Corp., an 80% owned subsidiary of Blue Chip Stamps, managed by Louis Vincenti, and See's Candies at 99% owned subsidiaries managed by Chuck Huggins made good progress in 1977. Since See's was purchased by Blue Chip Stamps at the beginning of 1972, pre-tax operation earnings have grown from $4.2 million to $12.6 million with little additional capital invested. See's achieved this record while operating in an industry experiencing practically no unit growth. Shareholders of Berkshire Hathaway Inc. may obtain the annual report of Blue Chip Stamps by requesting it from Mr. Robert H. Byrd, Blue Chip Stamps, 5801 Southeastern Avenue, Los Angeles, California. Warren E. Buffett, Chairman. March 14th, 1978. Ooh, so that's the first one, guys. And honestly, this is the first one I've read that I actually remember reading. I remember 3 years ago I went to go look at these, and I don't know which year I picked, but I remember trying to read it, and I didn't just find the shareholder, I found like the entire year thing, and I remember trying to like go through it. I was like, I don't understand any of this, but from the education that I've gotten now over the last 3 years, and even more recently within the last few months, I kind of actually understood a bunch of this, and I'm very grateful to be reading this actually right now. I think this is the time for me to be reading it. I've read one other one of these for another company, and first off, it's not as clear. It was not as clear, and two, the way he puts in the negativities, right? He's like, oh, we did do this wrong, and this was another thing we messed up on. He's like, but, you know, this mess up actually didn't negatively impact overall. We still had a very successful growth rate there. And he's like, but this other one, we're seeing that even in the future, textiles aren't going to be doing well. So, like, this is something we're going to have to figure out. And he even says, like, you know, this is something that we're learning and maybe even having to relearn right now. The honesty in it is just outstanding. I'm kind of nervous to read other ones now because I don't think they're going to be as straightforward and clear like this. But this was well put together. It's a bit long, but it's well put together. He's an immaculate person. Damn. Is he autistic? I'm kind of like blown away a little bit. I almost want to read it one more time. I actually might read it one more time, take some notes. There's some names here I want to go look at to see like when they passed, how long, what their stuff looked like. I do want to double check to see, you know, I've heard about See's Candies and the positivity that's done for them, but I want to look at these other insurance companies and see how they're doing now, how long they lasted after this, when they sold and stuff like that. I'm sure like in the next ones that we read we'll eventually see that, but I would like to keep like a little notebook. So, you know, I would encourage you guys, like if you didn't while you were listening to me read, maybe go read it yourself or re-listen to it and take some notes on some of the things you want to dig into. It will also be helpful not only for learning what has happened, but helping you create the style in which that you will take notes on future ones that you will read that are current, and maybe be able to notice some patterns from these ones that you could catch from the newer ones, and that will possibly help you. I think it will help me. So I look forward to being here with you guys next week to read another one of these. If you're finding me on YouTube, please don't forget to subscribe, like, and hit that bell icon so that way you know the next time one of these videos is going to come up. And comment down below. What did you get out of this? Did you understand it? Is there anything here that you're like, oh, I need to learn more information? Yeah, just tell me what you thought about it. And until next time, guys. Bye!